Good morning, everyone, and welcome to our DAT IQ weekly market update. This is our Tuesday update for Tuesday, 2/22/2022. I'm Ken Adamo, Chief of Analytics here at DAT, joined only by Ned Damon, who's our Principal Data Scientist. Good morning, Ned.
Good morning, Ken.
Our audience may notice that it's just us today. Dean is sipping wine in the wine region of Spain, watching the yachts float by. I'm getting intermingled pictures of wine, sunsets, boats. He seems to be having a good time.
Yeah, no, it's a rough one for him.
I know. He should have said he was on assignment. He did say he was sending me some freight updates from Spain, but mainly wine recommendations.
Fair.
So for those unfamiliar with the show, we're here every week, typically in a nice studio, but I had some calamities this morning that have relegated me to my basement, talking about changes in the freight market, trends we're seeing, but most importantly, answering your questions. So if you have any questions for Ned or I, please drop them in the chat below. Our marketing team will get those over to us. Also, we have a listener survey. I'd really encourage everyone to check that out. I believe it's super quick to answer. It just helps us guide guests and topics and understand more about the audience for our show. So with that, I'm going to bounce into the key points of the week, and then Ned and I are going to tag team Dean's part and try our best. So key trends. Spot rates down a bit across the equipment types. It's an interesting trend you'll see in the load to truck ratios where flatbed's the only one bucking the trend, but that's a bit seasonally expected with housing starts. But the other two are really starting to fall in line to where we'd expect seasonally. Used trucks for sleeper trucks broke $100,000. That is really nuts. What's Dean put here? It's a average truck was 68 months old with 451,000 miles for $100,096, which is kind of crazy when you think about it. And then we've got a bit of a tease. It was 56 degrees here in Ohio. It'll be 60 today, but we got another polar blast coming through on the eve of the anniversary of the polar vortex that could drop anywhere from 3 to 13 inches of snow. So with that, I'll turn it over to Ned primarily, but I'll be here with some witty comments in the background.
Oh, boy. So I'm going to warn everybody that I am basically 1/4 as good as Dean is at this, and I'd say that Ken is 1/3, so you're not going to get the full Dean worth of analysis on these particular charts. But we'll do our best. So we're going to start off talking to dry van load to truck ratios. You can see the purple line indicating the 2022 dry van load to truck ratios are continuing a relatively modest downward coast. I don't think that there's any particular interruptions in that trend. It's a little unusual. It's following a little bit of what we expected in 2018, although slightly time shifted. The 2018 drop happened faster and earlier. So maybe we'll level out somewhere around the 2018 level. I don't know.
That red line, Ned, is 2021, right? The polar vortex kind of extreme spike that we saw around week 7 through 11 before it subsided. So I think that purple line probably has its sights set on where 21 normalized after the polar vortex, which was like probably be around 5-ish. So we'll keep a close eye on that and see where that ends up for dry van.
Yeah, it's really just going to depend on how the weather cooperates. Moving on to reefer, you can see the same sort of pattern where it's like we're running 2018 but through molasses, where the drop is slow and steady. The polar vortex didn't seem to affect reefer quite as strongly back in 2021, although that may be more of a data artifact of how sharply it shot up in the later part of it may be an artifact of how sharply it shot up in the late part of 2021 and the early part of 2022. Any more commentary on that, Ken?
No, I think this one's interesting, right? We joke and kind of, it seems like we're just talking, but when we say sight set, I mean, these things have momentum, right?
Right.
So when rates are on a run upwards, they tend to have momentum carrying them up. When they're on the downslope, they definitely tend to have momentum. And keep in mind that there are more parties incentivized to have rates lower than higher. Mm-hmm. So when they smell blood in the water on rates coming down, it can tend to accelerate downward shifts much faster than sometimes. What do they say? Just like the stock market, it takes the stairs up and the elevator down.
Yep.
That's a very common behavior that you'll see. So it's really going to be interesting to see what happens here over the next few weeks, because produce will start to pick up And again, if Dean's watching, what did he say from the Rock of Gibraltar? If he's
Yes.
watching over there in Spain, he would probably be violently correcting me. But we should expect to see produce pick up at least in a significant way by middle to late March in Florida and in South Texas. So
Yeah.
how
But
far reefer falls between then and now will largely set the tone for where it is when things start to pick up.
Yeah, I would say though that in general the reefer market is kind of self-correcting about that, where most of the carriers know when the season is happening, and so you don't see like the sharp shocks as much in the reefer market as you do in some other equipment types. Anyway, moving forward.
But right, to kind of
But
hang on that point though,
yes,
typically it's so much more lucrative to run reefer than dry van that they have no problem pulling the capacity back because those power units are
yes,
typically fungible. Right
hmm
now, if it's super lucrative to run dry van, they may have like a self-inflicted capacity crunch, which is really what you saw to end last year. I mean, it shouldn't have been as busy
yeah,
as it was for reefer, or shouldn't have been as tight as it was. But the fact that they were able to haul so much profitable dry van freight kept them out of that reefer market by and large. So just something to think about.
yep. Onto flatbed. It looks like we're once again doing the 2018 through molasses, although we saw a near pitch perfect mock of 2018 on 2021. Looks like the levels are a little bit higher, and it's interesting that this is the one equipment type that's bucking the trend a little bit about having some positive momentum, even though it's at such a high base level. And I think that's partially due to overposting behavior, which is not taken out of the load to truck ratio, sad to say, but it is taken out of the MCI when we get to that.
Yeah. I just think a lot of folks are trying to get, Dean had a point earlier about the housing starts. It's just they're trying to get in under the wire of the Fed raising rates. If you lock
Yeah.
in now, if you get your mortgage locked in and your draw set up for your home builder, you'll largely avoid. I mean, interest rates could very likely exit the year above 5% for a 30-year fixed. So something to think about.
I mean, yeah, this is just maybe slightly off topic, but the question is what wins out on the interest rate versus the lumber prices, even though the lumber prices have been dropping.
I think they're back up,
starts.
though, Ned. I mean,
Oh, yeah.
yeah, I think a sheet of plywood where I live is $120. So, yeah, fun times.
Moving on to MCI. Once again, we do not have the detailed market insights that Mr. Croak has, but we'll do our best. It's interesting to see this kind of bifurcated map. This is the MCI dry van map. Blue indicates lower MCI, which is typically a looser market, and red indicates a higher MCI, which is typically a tighter market. California and the Pacific Northwest in general being blue is, I guess, somewhat unsurprising, but also like it's pretty cold here in terms of MCI, not in terms of the actual physical temperature.
Yeah, I mean, LA was 100 for weeks and weeks and months on end. So, other than Southwest Arizona, which again, I don't have the insight into what's happening there. Maybe that's the illicit avocado route north. But there's something going on there.
Vans.
Yeah, for dry vans. It's interesting too. It doesn't really heat up as much even with the reefers, right? You see,
Yeah, moving on.
LA is hot.
Yeah,
California's still pretty cold.
It's not that hot. Yeah.
Right.
Idaho's hot. Is there a spring? I feel like Dean would chime in with whatever spring crop there is in Idaho for reefers. But
yeah, we're on the reefer MCI map now, and I don't see anything overly crazy to think about. I mean, there's even pockets of coolness along the East Coast. I mean, if you look at North Carolina, South Carolina coastal regions, Southern Alabama, Georgia, Mississippi, just not. I mean, there's shades of pink, but I mean, even look at Chicagoland area. It's
hot,
the immediate metro area is hot, but immediately to the east and south and west are not as hot as you typically see from a spillover effect. So definite signs that things are softening.
Yeah. Finally, moving on to flatbed. Here we have hot markets all around except in Nevada, which, I mean, I guess this is outbound, so you're not getting much outbound from Nevada. But in general, my expectation is that Nevada is one of the West Coast states that still is adding a lot of housing starts.
Yeah, or as we call it out here, Nevada.
Nevada.
Yeah, I don't have much insight on this flatbed map other than it seems to be really hot right now. I mean, diesel prices are high, rig counts are up. You're seeing rocking and rolling in the shale areas, Bakken, Utica, Permian, so Marcellus. So, and then with the housing starts. Unless you're in Miami, central, western Nebraska, or Nevada, you're doing pretty well. It's interesting, though, right? The Bakken area of North Dakota is a little bit cool right now. That'd be something to look at over the next couple of days.
Yeah. I do want to not to venture too heavily into the geopolitical space, but I don't think that it's likely that what's going on in Europe is going to have a huge impact, at least right away, in terms of oil and gas drilling here in the United States. You might get more shipment since Nord Stream's been canceled of liquefied natural gas, but that can't really scale up in any kind of a meaningful way. So don't expect a boom just because stuff's going on in Eastern Europe. If you're in the oil and gas industry.
Yeah.
Yeah.
We could do a whole show on that one.
Oh, jeez. Yeah.
Do you want me to cover spot rates, Ned, or are you going to handle that one too?
No, why don't you, so I don't have to duplicate myself talking about spot rates.
Good. That way you can save it for the forecast. All right. So just to level set with our producer, we're on DAT dry van rate trends. So, this is a really interesting chart, right? Purple is 2022. The legend might be a little goofed up here, but red would be last year. And then the burnt orange would be 20. We've been at sort of that ceiling on the dry van side for a while now. And I think there's really a lot of questions about what happens to rates over this next quarter and a half. I think that's going to set the tone for the rest of the year and maybe even heading into 23. I'm sorry. It's crazy to think about. We are hearing anecdotally and through some of the alt data that Jason Miller was just talking about how December and January seems to have been high watermarks. We're seeing a ton of volume shift over to the contract market. So all signs indicate that sans World War III, we should see downward rate pressure, like net downward. So if you think about the puts and takes, fuel up, Class A truck orders still not getting delivered the way that we would like. So those are upward pressures on rates. But the huge shift towards employee fleets, leased on fleets, and the corresponding bump in contract volumes should be enough to ebb back some of this spot rate demand. But we will see. We've been wrong before.
Yep.
Go ahead, Ned.
No. I was just agreeing with you. Like, it's hard. Predicting things is very hard, particularly about the future.
Sure. Moving on to reefer, this mirrors. So if you remember Ned talking about the loaded truck chart, reefer had a bit more of downward pressure and downward movement. You're seeing a very similar thing here if you look at the purple line. Reefer had more of a slow and steady story throughout 21, which is the red line. So it'll be interesting to see, again, year-over-year comps are going to start to, as these things pinch together, year-over-year comps start to evaporate. So if you're looking in your TMS at your reports year-over-year, even though rates are really, really high, you might see year-over-year flat to decline. And then flatbed, pretty much holding steady, right? It will run out of year-over-year growth if it stays exactly where it's at sometime by the end of the first quarter, right around day 120-ish. So with that, I will turn it over to Ned back into his wheelhouse to talk about our forecast. Ned?
Certainly. We're going to start off with the dry van forecast. In blue, you can see the market rates observed by DAT. And then off to the right, you can see our forecast models. There's pretty broad model agreement heading through next week. But then beyond that, there's a little bit of disagreement over overall direction. The short-term model is expecting things to drop. I think it's a little bit too aggressive on the drop. It's looking like about 7 cents of travel over the next month or so. I think that we're going to continue to see downward pressure, but I don't think quite that much. Ratecast is expecting a little bit of a pickup as we head into the early part of March. And then the blended forecasts are leaning more towards, which are in gold and silver, are leaning more towards the short-term model heading downwards, but a lot less. I feel like those blended forecasts are probably have some good insight into them. Moving on next to the reefer chart. Once again, in blue, you can see the market rates observed by DAT. And then off to the right, you can see, once again, there's kind of model agreement in the next little period, although I don't know what the short term is thinking about that drop happening right around now. Beyond that, though, it's a similar story where Ratecast is expecting rates to kind of maintain their current level, maybe with a small overall downward pressure, whereas short term is expecting a much more aggressive collapse, again, like 7 to 8 cents of travel. Short term in red, Ratecast in green, and the blended forecast in gold and silver are leaning more towards the short term, dropping by a couple of pennies through the next month. Finally, moving into Flatbed. I apologize for the dots left on this chart. I am not quite the chart wizard that Dean is, and so I did my best to replicate, but I made a copy paste error, it looks like, and so we got with the selection lines, which I cannot remove at this point. In blue is the market rates observed by DAT, and then off to the right you can see our forecast. In red, the short-term forecast is following that similar pattern of down about 5 to 6 cents through the next month. The blended forecasts in gold and silver are, which are mixtures of the short-term and the ratecast model, are holding slightly steady to a little bit down. And then ratecast actually is expecting things to pick up a little bit through the next month, maybe about 5-ish cents of growth as we head into the later part of March, which I'm a little surprised by. But that is it for that part of the forecasting. And now we get to talk about our IQ question of the week, which is, what is the top secret project that Ned has been teasing? Ken, do you want me to just keep talking? I don't know. I feel like I'm going to get myself into danger here.
Well, yeah, let's catch folks up to speed who may be first-time listeners or haven't listened in a while. So the past few weeks, we've been putting out calls for folks to reach out to us at askiq@dat.com. Ned's been working on this new model, which we'll talk about in a second. Thank you, Sean. I picked out none of the art in this basement, but he really likes the pig over my shoulder. There's also a giraffe with lipstick over here, and some other interesting things down here. A frog with big glasses. So we've been asking for sample shipments, like actual moved shipments, to run through and score, right? So that's just a fancy data science term to say what did the model think about this? And we've been getting some really great participation from our audience. We've been testing the model, big and small brokers alike. Some of the top 5 brokers, some of the smaller brokers. So, Ned, when someone sends you a file with some shipments in kind of like base layman's terms, what exactly happens next?
Well, I take the file. So there is some information that I do not expect people to be able to provide, but that I can look up very easily. This is things like lat long information about the origin and destination point, some other just sort of basic stuff that I append onto the data. And then I feed it into, we have now in the wild web somewhere that I'm not going to disclose because I don't want it to get completely hammered with API calls, a service that I can basically feed lanes into, and it chugs along. And what it's looking at is, it's a different way of modeling rates. I'm not going to go too deep into this unless you ask me for more details, Ken. But fundamentally, the idea behind rate view is that it's a lane level forecaster, where it's fundamentally looking at everything that happened on a lane, but it can't look at anything that's happening on nearby lanes. It can do it a little bit through in ratecast through MCI, where MCI information allows us to kind of share stuff across lanes, but fundamentally each lane is being looked at on its own. This model is much more global, where there's a lot more interplay between different lanes. Lanes are allowed to like interact with each other. And they're also, it generates this idea of like similar lanes. So like, for example, lanes that are geographically similar might be similar, but also lanes that have like a similar kind of behavior. It generates this idea of similarity, and then it uses all similar data points inside of the RateView database to try and generate a prediction. So it allows us to really leverage things that we can't quite do inside of RateView. So an example of this is that in RateView, the when you book versus when it picks up, obviously that's a really important consideration when you're trying to price a load. Like if you need something that picks up today, you're going to have to probably pay more for it than if you want something that picks up tomorrow. But in RateView, because we're looking at just only relevant data points and we can't do any transfer learning, we can't provide that kind of guidance. Like if you could book it today or tomorrow, if you could, how much does this affect things? How much does the weight affect things? How much does hazmat or other like specialty load needs affect the price? We can't do that inside of the RateView engine, whereas we can with this. So
just to kind of jump in.
Yes.
So your average Chicago, I'm just trying to distill this down, like Ned's
right,
like up here, right? As high as it goes from and then we need to get it down here
Okay.
for me
All
to
right. All
understand
right.
it, and then somewhere in
All
the
right.
middle for the audience. So let me just level set. So when you run Chicago to Atlanta in rate view, true or
Yeah.
false, you are getting essentially all non-outlier shipments entered into that average that transpired on that lane. So it's
Correct.
a mix of hazmat and non, short lead time, long lead time, 20,000 pound shipments, 50,000 pound shipments, 10 skids, 5 skids, et
Yep.
cetera, right?
Yes.
And a lot of that variability, right? Because when you go under rate view rate, you'll get the interquartile range and the standard deviation. So a lot of that variability is driven by those underlying variables. Not all of it, but we
Yes.
can explain some of it with those underlying variables, correct?
Yes. Correct.
So hazmat should be more expensive than non-hazmat. And if your lane has a lot of hazmat shipments, it seems to reason that the distribution would be wider. And rate view would give you a wider, potentially a higher standard deviation, right? A higher dispersion of rates. So this new thing that we're working on, it cares about and thinks about those variables and really seeks to pinpoint where in that distribution this particular shipment will fall. Is that right?
Yes, that is exact. Thank you for putting it much more succinctly.
No, like I said, you're here, I'm here, audience is somewhere here. So, but then let's just kind of take this to its logical end. This doesn't seek to explain all variability in rates because some of that's irrational, right?
It can. Yeah. Well, some of it's irrational and some of it's idiosyncratic, right? Like we don't want to have information about individual brokers and individual carriers. Like, do you know this guy? Obviously, at some future point, we might care about that. But for right now, we try and leave like relationship-based stuff out of it.
Right. So the irrationality or the unexplainability is really in two large buckets. It's one, things we don't know, or two, things we can't explain.
Right.
Right. So we don't know who the broker was or who the operations person was that covers the freight. We don't know who you're talking to on the other end. Right. So carrier A may be maybe a tougher negotiator than carrier B. But we do know is that by and large, whether you're a tough or a lax negotiator, you should be charging or paying more for hazmat, or you should be charging more or paying more for heavier weight shipments.
Yes.
So this is a really cool thing. And it's not a rate view replacement. It's definitely an enhancement. And we're going to continue to test it. So keep the requests coming in. I think Ned has it down to science at this point for testing these things. The API is getting spit shined at the moment. We should have a beta API if you are Python inclined, or I guess any.
You can use Postman. Postman's fine. Yeah.
Yeah, Postman or any kind of
Alteryx,
however you tend to interact with RESTful web APIs. You probably can give that a whirl here in the next couple of weeks and give us feedback.
Yep.
Anything else to add?
It's still in development, so I wanted to thank the people who participated. We're still making it better. There are improvements that we are working on. Most notably, right now it's doing okay, but it could do better on short haul, and so I'm trying to really get that buffed up because that's
short haul's tough, right? Because $10, $20, $100 has a big impact on rate per mile on short hauls. Whereas if you're off by $50 on a 2,000 mile shipment, you're not off that much.
Exactly.
So something to think about. And yeah, this is really cool. While others are kind of competing with where we were 10 years ago with our little science fair projects, trying to recreate rate view, we're sort of really challenging ourselves to get out in front of it and offer something to help fortify, to give you rate view and then the context with which you can move that particular shipment.
All right, we ready for some listener questions?
I think we are.
Mirza Begovic says, what do you think about driver shortage at the moment, and what are your predictions of the market for dry van from Midwest to East? Thank you.
Well, you're asking the wrong people for that driver shortage question. I think Dean's more opinionated on that than we are. So I think the short-term issue around getting butts and seats will continue throughout this year until it catches up. This really isn't, we don't have enough time to talk about the long-term driver shortage and whether or not it exists or to what extent it's swaying things. But I think in the short term, there are asset fleets that are offering pretty substantial sign-ons and driver pay increases to get people in the door, get people through CDL driving school and all that. So short term, I think you might see some catch up, but long term, it really just subscribes. It depends on what narrative you subscribe to and what your reality is around whether there is or isn't a shortage for drivers.
Yeah. And
and then Midwest to East. What do you want to take that one, Ned?
I mean, I don't have the forecast pulled up right now. I can. I don't really want to speculate without me having the data. That goes poorly. I eat hats.
No, I mean, at the end of the day, we'll
Yeah.
see. Things should, in a normal year, I would expect things to be slow through March into April. And then as grills and patio furniture and outdoor activities and all that stuff starts to really, really ramp up, you'll see kind of this crescendoing effect into the 4th of July, and then things will dip. So that's really sort of the Midwest pattern. Some of that, traditionally speaking, is because dry van capacity is pulled out to go haul reefer freight from south to north and back again. So we'll just have to see what this year brings in terms of is it somewhat normal or does it continue to be just nuts?
Yeah. Airboss Johnson asked, do you have data that shows whether high cost of fuel will cause carriers, especially small carriers, to run slower and therefore fewer miles? We have kind of a tangential thing, and that is that we've been recently looking at the length of haul. And recently, again, this is very, very recently, there have been signs of an overall increase in length of haul among shipments. Again, this just last couple of months, but it's pretty significant.
Yeah, I mean, I don't know. Do you worry about how much the 12 ounce versus the 8-ounce steak costs when you just got a big fat bonus at work? I mean, if you're like a very, very disciplined, cost prudent carrier and you're operating multiple trucks and you're very kind of focused on your P&L, I'm sure you'll run slower, closer to 55 miles an hour. That tends to really come up as a discussion topic when rates are low. Back in May of 2020, May of 2020, when folks were protesting in front of the White House and the rates were like $1.35 a mile, Dean was on here giving advice to folks to just slow down. There's hardly anyone on the roads. It's easy to go faster and burn more fuel, and you can't offset it with rates. I really think the high rates are subsidizing the fact that, like, you have to prioritize. Obviously, be safe, run the speed limit.
Yes.
Don't violate hours of service, but you're much better off to take more shipments. And if driving 65 where permitted allows you to haul more miles and more shipments, the increased rate per mile you're getting far offsets the increased price you're paying in fuel.
Yeah, completely agree. But the one caveat on that is assuming that the rate environment stays the way it is. It is.
Absolutely.
Right now
Yeah. I mean, you have our word. And I'm sure, again, Dean will be the first to kind of, he talks about this all the time. He tracks very closely fuel as a percentage of total revenue. And when that number starts to get a little tighter is, I think, when you might want to start pulling some levers. So again, obviously be safe, but haul as many miles as you can loaded.
Yes.
You would be foolish to not maximize your loaded miles right now. We all, again, it's just human nature. We should all be maximizing for different things at different points. It shouldn't be one absolute, right? There are times you maximize family time, you maximize work and all that stuff. But when you're out there driving, there's sometimes to maximize efficiency and sometimes to maximize revenue. And right now, maximize revenue.
Yep.
One more.
Mihalo J. Reefer market is going down. So what would be the best lane these days for a reefer truck in your opinion? Man, these specific questions. I wish you were here.
Yeah, I mean, it's going down, but it's like,
it's
I don't
pennies.
know. It's not like down that much.
Yeah, it's like 3 cents ish.
So, I mean, I would be looking at where the MCI map is the hottest, which was pretty much the East Coast, the Southeast. You really only have a couple more weeks before produce really starts to pick up in the South, even if it's just some of those initial loads. So getting equipment back that direction or starting to work your way back if you're kind of stuck in a cool freight area would be prudent. But you're on the foothills of the busiest time for reefer of a year. So keep that in mind. And hey, I mean, take advantage of these polar plunges, right? It's warm now, but it's about to be really cold through much of the Midwest and Northeast. That's going to be a lot of protect from freeze freight. So if you can get a load up there to a typically low paying area, it might turn into a high paying area in the next couple of weeks while people are trying to protect stuff from freezing. So just stuff to think about.
Yeah. I think that's it. Did we have shout outs that we needed to do?
Yeah, I think Slack's down. So even if marketing did put my notes in Slack, I wouldn't be able to retrieve them. So a couple things. We're sponsoring a concert with free tickets at Matt's. Clay Walker is, I believe, the artist. So we have a bunch of tickets to give away. You can check out our promo for that. If you're going to the Mid-American Truck Show, we'll have a presence there. TIA is also coming up in a few weeks, I guess, at this point, if not a month and a half or so. We'll have obviously a huge presence there, sponsor a party, all that kind of fun stuff. I'll be covering for Dean for a couple engagements this week. Don't forget that listener survey. It would greatly help us out to put more tailored content in place. What else? We'll have Nicole Glenn from Candor Expedite here on next week. I'll be live on location in Denver, Colorado. What else, Ned? Am I missing anything?
If you have lanes that you would like to run through our new beta model, please send them and send an inquiry to askiq@dat.com, and I'll get you back fill out a little template form to submit them with.
Sure. So with that,
not too many though, please. Yeah,
we're going to get out of here before we get ourselves in too much trouble or have to extract our feet from our mouths any more than we already do. So I do enjoy you tuning in. Hopefully this was a nice reprieve while Slack was down and you couldn't post dank memes into your corporate channels. And I'm looking forward to talking with Nicole next week as a fellow expediter. It should be really fun. Oh, I do have one thing. Get your questions in early. We've gotten tons of questions over the last few weeks about smaller equipment types, expedite, sprinter vans, cargo vans, box trucks. So Nicole is an expert in all of those things, and she currently runs an expedite company, and they deal mainly in smaller equipment types. So please drop your questions either on our LinkedIn through askiq@dat.com. I suspect we're going to have a bunch of them, and we are really limited on how long we can actually run the show. So please get those questions in early so that we can get them, and it gives Nicole a chance to really noodle on the questions for a little bit longer. So with that, I'm going to get out of here. Thank you, Ned. Thank you, everyone, for listening, and I hope you have a great week. Goodbye.
Take care, all.